that's what we're going to cover today. Three different strategies that I will be using in order to be profitable in the coming bull run and not to lose money when everything's going up, which, people do that. So, trading consistently in volatile markets, right? Right now, when we look at Bitcoin, when we look at basically any other crypto coin, we have been pretty volatile the past few weeks, and we finally had some momentum volatility, and we're going further up. So that means a couple things. First of all, obviously, prices are going to go up in the entire crypto market. Also, a lot of new people are coming in, and they're looking for ways to get rich immediately, right? So by default, all the trading is going to be biased to the upside, just because there's a lot of new money coming in. The question is, how is it being allocated, right? And you basically have two buckets, which you have the main coins, then you have the altcoins, and then you have the shit coins that have the biggest percentages in gains, and that's something else to look at. But right, so we're going into a bull run. The market is very volatile, and this is the time where a lot of millionaires will be created, but it's also the time where a lot of money will be lost. So going into any environment, especially this one, but as we say to any other environment, we want to have a strategy, and that strategy has to have previous proof that it works, and we stick to that strategy regardless of what emotional triggers we might have around us, which we will have a lot. So this is the most important time to stay focused and to stick with your strategy rather than having emotional triggers to do dumb things. So you need to know how to trade this market correctly in order to make money. And there's this one saying, I think I said it a couple of times before, but there's this one saying, it's this one truth in crypto that will always be true no matter what, and that is that your dumbest friend will make the most money. And there is something it's interesting to think about because it's true, really. And what it means is that people that don't overcomplicate it will make the most money, and anyone that is not triggered emotionally or does not do emotional actions will probably have the most success. So the way we're looking at it at Quantum Code, and the way I'm going to be trading it, and the way I will tell you guys how you can trade it too, is by setting up three different ways or three different strategies, and then just sticking with that no matter what. Why? Because that has been something proven to work many times over. Right, so let's look at the overall market. Let's look at Bitcoin and a couple other things. So first of all, we've been ranging around here for a long time. We know that. We've been trading this on our live calls as well. Then we skyrocketed into a second range around like 50K. And now we're here, right? This, once again, our stochastic strategy, we're in a strong trending market. So really what we want to trade here is longs only, right? So whenever we have, whereas before, when we're in a ranging market, depending on what the time frames do, we can long and short. Now, because we're so strongly biased to the upside, we'll only long. So whenever we have our stochastics bottom out and them being aligned together, that is the perfect time for longs, and you will have a much easier time longing than shorting, just by default. So when we look at Bitcoin, obviously when we look at the 468, We just turned around midway, went further up. At this point, the stochastics are so topped out that we need to go to the higher time frames, which are also topped out all the way to the weekly and monthly. And this is how it looks like usually when we have our bullish runs. For example, in January 21, we topped out just about here as well before we started moving further up. So overall, we're in the trending market, obviously. When we go to total 3, if you guys don't know what total 3 is, it's the combination of all coins except the top 3 coins, right? So that really just tells you the strength of crypto without Bitcoin, ETH, and so on skewing the data, because the top 3 coins obviously make up for, I don't know, a large percentage of the overall market cap of crypto. So by removing them, you actually see what is the health of crypto. And as you can see, Bitcoin is close to its all-time highs, right? However, total 3 is very far from it. And when we look at the stochastics here, all of them are going to be topped out. But total 3 is very far from it. Total 3 topped at, 1.1 trillion. Right now it's at 660 billion. So, almost half. So there's still a lot of room. What this means right now is that there's a lot of money flowing into Bitcoin and not that much flowing into altcoins. And that is usually the case where, first of all, think about it just psychology wise. When people hear about crypto, first thing they hear about is Bitcoin, right? So where's most of the money going to flow in from new people? It's going to be into Bitcoin. And once they get familiar with other stuff, and Bitcoin does not give them their 1000x gains, right? They get bored of it and they start looking further, and then you get into the altcoins, and then that's when money flows in there. And there's where you also have a lot of multiples. So with Bitcoin and with the altcoins, it's also important to understand where are we right now. We're close to the all-time high, so most likely we're just going to, we might have some consolidation time, but we're probably just going to go higher. And that is probably going to stay the case for, up until 2025. We'll have a pretty bullish run. So that is a very, very good setting for new money coming in, for new coins taking off, and so on and so forth. And those are the things that I want to talk about today and cover today. How can we be part of the market, and how can we engage with it and be profitable overall? So there are a few ways to do it, and most of them are focused on longer term. With longer term, I mean multiple weeks and months, not multiple hours, simply because it's a very, very volatile market. And because we already established we're very strongly biased to the upside, what that means is that the longer we stay in, the higher the chance that we will just naturally, the price will just naturally go up, right? So as we do that, we eliminate, or we decrease our risk by time, which this is a very, very advantageous situation to be in, because when you trade normally, right, in a normal ranging market or something like that, and you have a signal, right, let's say you have a long or short signal, then, when you analyze it, I spent, I don't know, hours and hours the past few days and weeks on analyzing our strategies, our dashboards, more preparing them for, the bull run, and, looking at their performance. We'll go over that too. But in general, when you have a signal, the signal has some edge, right? That's the point of the signal, that it has some edge over the market. And usually over time, that edge decreases. So essentially, the longer you are in the trade, the less likely it is that it's going to end up profitable, because your edge is slightly decreasing, because the longer or the further away you are in time from the signal that you had, the weaker your edge is. So that's usually the case. However, now the longer we stay in the market, the higher the chance that the market is just going to go up, because just new money's flowing in. So it does not matter what price action there is, what the indicators say, there's just physically more money in and needs to go somewhere, so the price goes higher. So because we have that, the longer we stay in, the more we increase the likelihood of the price going higher. That is in a bull run, right? So we need to make sure that we don't overshoot, but right now we're in a pretty good position. So so that goes into, okay, how can we trade it? Well, let me just make a second chart here. Let me open up Bitcoin. And here are the ways we can trade it. So number one is you can just trade it the way you normally trade, with some specific adjustments. So first of all, we want to make sure that we're strongly biased to longs. But really, if you have a trend following strategy, then you can just trade this, and you can probably trade it on multiple coins, right? But just a simple trend following strategy going into a bull run is going to end up profitable more likely than not, because the entire market is just going to go up, right? So step number one is holding. You can literally just hold a bucket of coins, and that's it. Like literally hold a bucket of coins, go off of your computer, and come check back in like once a week and just let it ride, right? You would be fine. That's number one. Number two is if you want to be more hands-on, like once a week you can check in, you can slightly adjust your trades. So you can look at, say, the 4 and 6 hour, and look at this. This is a very volatile move to the upside when it starts like this. But really just looking at your mid time frames, 4, 6, 8 hour, looking at the stochastics, waiting whenever your stochastics bottomed out, enter then, let it ride. Whenever the stochastics turn against you, you take profits, you reload, you enter then. The advantage of that is that you reload multiple times, so you're compounding, right? Let me explain this a bit further. So option number one is just trading it, right? Trading it with bias. So we can either just hold a bucket of coins, but that's a different thing. When we trade it, we basically let the market do its thing. We follow the trend, we ride the trend, and then in a consolidation, we take out profits and reinvest those profits with a larger position size, and then we just compound. And then we wait for the next leg up. And then we do the same thing. We take profits, we reinvest, and then we do the same thing. And we can also distribute into different coins, but really what it is just we use the compounding effect in the move up, and we do this as long as the price moves up. And we need to do it strategically, so you don't want to blow your entire account by being in 150% or something like that with leverage every single time. You want to distribute, but really what it is as long as crypto is going up, you just ride the wave, and you ride the wave, you take profits, you reinvest, and you do it over and over and over again. If you did that, even now, I don't even have to go to the old bull run. If you did that every time here, say on a 6 or 8 hour, depending whenever we bottom out on a stochastic. So when we bottom out on a stochastic, you buy, you wait till there is a consolidation, and then you wait till we bottom out again, and then you just buy again, reinvest, and you just keep doing that. You can do that on the 12 hour, 8 hour, 6 hour probably as well. Right here and here. So, simple. Keep it simple, stupid, right? That's option number one. Now, with the trend following strategies, you have manually trading it, you have your risk associated with it because you're actively in and out of the market, And even now, the market's trying to trick you, right? So as long as you don't have any indicators or any, you still need some kind of edge, right? Because you can burn yourself if you trade without um, any strategy or structure. So that would be pretty important to look at that and not just blindly go long. If you're trying or if you're planning on going in and out of the market. So stock strategy, trend following, like the ETH turtle, for example, wait for the stochastics to go down, wait for the higher time frames to top out, but really whenever the stochastics turns around at the bottom to the upside, that's a great way to enter in. So you can just buy these times. However, it is easier than it sounds. It sounds easier than it is, sorry, because you have that mental, you need to have that mental strength in the drawdowns, and you also need to have the overall capacity to understand the market to make sure to, not enter at tops and then weather drawdowns and then, hopefully not exiting in them before you have a big move up, which is something that many people do. So that's important to note. So that's option number one, trading it. Option number two is something that I've seen also, same as trading it. I've seen many people make a lot of money with that, which is buying or investing into buckets of coins, of altcoins that have the potential of going really high. And you can do that with very aggressive coins. You can do that with mid-range coins, and you can do that with more consistent coins as well. So I have a list of a couple that we can look at, but there's a lot of variety that you can do, and the more aggressive you go, the higher the upside, but then also the higher the downside. And really, this is just a math problem of you ideally want to enter coins that have a very low market cap, because percentage-wise of your investment to the market cap is a pretty high percentage. And then if that coin grows into 100 million, $1 billion market cap, then those are huge multiples of your investment that you get. I'm thinking about a couple coins here that we can do it with. Obviously, RNDR is one of them. RNDR, a little bit of a background. I learned about this coin in January 23, so a little over a year ago. And I learned from about this coin from one of our investors who's been he's old now, but he spent around 50 years on Wall Street and very good intuitive trader. And the way he did that was the way he found this coin was, smart guy. He was looking at the overall market, and even then, January 23, that's a couple months after ChatGPT came out, and he was looking at the AI sector, and he was like, okay, well, the AI sector is pretty strong. Crypto and AI is probably going to be a pretty strong combination. So he looked at AI coins, and he got a bucket. He looked at the most promising ones, did some research, and ended up with a bucket of like 20 coins or something like that, which he then started investing in relatively evenly. And what I'm saying, he started investing in them, right? I've seen him enter a coin. It's not just a one-time transaction like buy, right? It took him weeks to enter a coin, like literally weeks of buying up the liquidity. And RNDR was one of them. And then he got a pretty good amount of multiples from that coin. And he was in strong enough to be able to exactly tell us what what level that coin is going to go to the cent. So then obviously it was pretty easy to trade. And why, how he did it, I don't know for sure. But he had a lot of playing room with the amount that he entered in with, for sure. So that was January 23, which is right here at 40 cents. So somewhere around here, we started buying somewhere around here, around $1.40, $1.80. And what he knew about this coin, he said, first of all, he said exactly that the coin is going to go to $3, like $2.80 something. He said actually it went to $2.90 something at first. Then he said the exact number later. But he was like, yeah, like it's going to go to 280, then it's going to drop down, and then it's going to go higher. But that was the first goal, $2.80, which is double from our entry. But then he said, okay, by 2025, I want this coin to be at $17. So I'm pretty sure that that's where it's going to be. So what people around me have been doing is just buying. Whenever there was a drawdown in RNDR, they just bought a bunch of RNDR, and that's it, not looking at it ever since. And, you know, that strategy worked for them pretty well, considering that RNDR went to $8 at the highs, so they have a pretty large multiple, especially the investor that, you know, bought most of his RNDR at 40 cents. So and he didn't buy, like he bought tens of millions of dollars of it there, and he kept buying the entire way. He's probably buying now. So that's coin number one, and this is what I mean with this. Buying, like thinking about, okay, what is the trend right now, which is obviously AI, you know, a bunch of other things too, and looking at a bucket of the most promising coins and evenly distributing your account in that, and then just watching the bucket grow. There's very few ways to go wrong about it right now, because in general, right, so if there's a bucket of AI coins, right, AI is trending right now, so by default that's good. And let's just assume that, you know, I don't know, $500 billion is going to flow into crypto over the next few months. Well, guess what that bucket is going to do that has a market cap of like $100 million max? It's going to explode, right? So those are your multiples, and the edge you have there is knowledge that people that flow in don't have, right? New people that just learn about crypto, they do not know about how crypto works. They probably don't even know what an altcoin is, and then, you know, eventually they'll get there. But then at that time, when those coins are taking off, then it's just going to be, you know, a snowball effect. So being in as early as possible is a very good option. RNDR is one of them. STX is another one. Also, well, you can see the coins. You can see the coins that that the investor was investing in. This one was at 60 cents in November 23. Now it's at $3. So and it's still gonna go quite a bit higher. I'm pretty confident about that, based on reliable sources. So STX is another one, and these are the more volatile ones, right? There's extremely volatile ones, which this is actually something that I have not been looking at right now, but there I don't have the list in front of me right now. But then there are meme coins, right, which are literally coins that have no real value other than the excitement of the community behind it. And there's this coin, I forgot its name, but it's named after Drake's cat. And I've seen one of the traders that I'm friends with starting to buy that coin a couple months ago, and I would like to check where it is right now, but I'm pretty sure that those are your biggest multiples. That is something that I do not invest in unless it's really just a fun account just to see what happens. But I like consistency. I like predictability. A bucket of mid-range coins is something completely else than low cap meme coins. The coin when he entered and had the market cap of like $1 million or something like that. So very, very low. But he's shooting for $100 million, $500 million, possibly $1 billion, because that is what meme coins did in the last bull run. So you have, and they will as well as now. The question is, or like the game is to find the right meme coin that will take off to $1 billion market cap. And when you invest, at a market cap of $1 million, then that's 1,000x right there. So I will not talk about any meme coins right now. I might maybe do a separate call about this just for fun, but I do not recommend anyone to buy them, have fun, but don't put your main account into meme coins. Like, it might work out, but it also might not, So buying coins with large growth potential is the second way of being able to trade. And then, right, we talked about our RNDR, we talked about STX. And then obviously you have higher level coins, which are like XRP, Solana. Solana has been doing great. Obviously, it really took off quite a bit. When I go to the daily or monthly, we can see how well it did, but it's nowhere close to its all-time highs, right? Which is like $260. So at some point we'll see them. We don't know exactly why, but also a good time to look at that. So number one was trading it manually. Number two was looking at buckets of coins that have a large potential and buying them and holding them, right? Holding them means exiting at the correct times, not overtrading them, right? Holding them means that whenever you have a consolidation or whenever you have a retracement period on Bitcoin, on the overall market, you can take profits, secure some profits, be smart about it, have risk management in place rather than just holding it forever, right? Holding Solana up to $1,000 and then back to $50, right? Don't do that. If you're in Solana and Solana ends up at $300 tomorrow, take some profits. Just take some. A win is a win, right? You already won. Like, yes, it can go to $3,000, sure, but don't gamble. Take profits. When you see your profits in front of you, take them. Old friend once said, nobody went broke taking profits, right? And it's very true. So that is option number one. Option number three is auto trading it. So this is a preferred option for many people because you eliminate basically all the downsides that we talked about right now, right? For the manual trading part, we said that you need to have the edge, you need to have the understanding and the knowledge, you need to execute correctly. For the holding part, we said that you need to have your risk management, and you cannot, just jump on a bandwagon without any thinking, because those people will hype you up for as long as they can. Even when the price is tanking, they will hype you up. So don't look at it emotionally, look at it logically, and those are downsides, really, the emotional factor and the factor of sticking to the strategy and going through that emotional pain of having to stick to the strategy, even though it does not look good right now. But at the end of the day, it's designed specifically to make profits. So that's that. The biggest mistake that people do also in auto trading is they take one strategy or one bot and then they put all their eggs into one basket, hoping that it's going to work well, right? Which, if anybody tells you that a strategy will like always works well and will never work bad, like that's a red flag right there. Every strategy has periods when it does well, and every strategy has periods when it does not well. And that can be an auto trading strategy, that can be a person trading. It does not matter. There's cycles always. So when someone tells you that the strategy is only going to work well, it's not good, right? The solution, though, is that since you're auto trading, meaning that you are not attached to it as a person, first of all, emotionally, but also you can, if you have one bot running, you can have 10 bots running, right? So you can use multiple strategies at the same time. And if you design it the right way, then those strategies are covering for each other. So whenever a strategy does not work well, you have other strategies that do work well, right? A great example for this are our dashboards, actually. Let me open them up here. And actually, I just did the reports on them since they were up and running till now. So we can go over them actually, and you will perfectly see what I mean with them covering for each other. So while this loads, let me just go ahead and open these up. Guys, let me know if you can see this. I know the recording does, but I'm not sure if the Discord sees these. Oh yeah, no, you do. I can see it. All right, all good. So here are these are two reports. They're the same. Basically, they're just two accounts. One's 2x and one's spot. And you can see the difference. I'm showing you both because you will see how the leverage affects the account. And even though the profits are higher, you will also have higher drawdowns. And higher drawdowns on paper do not seem like a big deal. But if you are in it and if you're watching this, and these are strategies that are swing trading strategies, right? They're not instant. So if there's a drawdown, you might be in a drawdown for a month or two, right? So sitting in a drawdown for 2 months, whether that's a 5% drawdown or a 50% drawdown, mentally, it's a pretty big difference, right? So let's just go to the spot account real quick and look at the strategies here. So this is the total equity growth since January 2020. And basically the same exact strategy, nothing has changed, and it's just running. And this is the overall equity growth, right? So this is the account. So this looks pretty consistent, and it is. However, like what, 18x, but without any leverage, by the way. But when you look at the specific strategies, that's when we're going to see why it's a huge benefit to have multiple strategies trade at the same time, right? So overall, we can just look at these are also, by the way, these are the stats that are important to look at with a strategy. It's not just the final value. It's not just the profit at the end of the day. Because there can be a strategy that's super volatile and just happens to be plus 1000x right now, but tomorrow it can be a minus 1000x, right? And because it's just volatile, right? So the final value or the profit at the end of the day does not tell you everything. It tells you very little, really. The question is what the other factors or the other stats that we have here. So within these, 4 years almost, no spot, like just spot, right? The max running drawdown, so the maximum the entire account has ever lost, is 30%. right? So, and you can adjust with this, because when you have this and you have it running, right? This is something that you need to have running at least for a couple months. And right now is a great time, considering we will be doing well with crypto. Crypto will be growing and active like well into 2025. So like that's why I'm making sure that everything with our dashboard is fine, because I'm basically sending it on a journey without any interaction for months and years really. So I was just making sure everything was okay. But the point is that in this entire time, the maximum drawdown was 30%, which is not a lot, right? And some people, if there's investors that invest with 10, 20, $30 million, then 30% is probably the maximum that they can sustain, right? However, if you're trading, then 30% might not be that big of a deal, especially when you're used to trading manually and you're like 20, 30x, and your normal drawdown is like 90% or something like that, which is, common, and I've seen that a lot. So that might be, too little. That means that you can use more leverage, because the max running drawdown allows you to do that for your risk portfolio. I'm saying this not because 30% is not a large drawdown. I'm saying this because I know that many guys here want more aggressive results, really. So max running drawdown is something very important. The next thing we look at is the standard deviation, and that really is the volatility. So how volatile is your account? And this really tells you, this number right here tells you how much this account moves. So if the final value is $1 million right here, and the standard deviation is 2%, that means that on average the account moves 2% a day. So that's not that big. Bitcoin, for example, moves, or I think Ethereum moves like 4.5% a day or something like that. So it's not that much. So the end value is more reliable than the value if the standard deviation was 20 or something like that. If the account would move 20% a day on average, then that would mean that it's really you cannot trust this final value at all, because it's just not gonna, it can be anything, because the account just moves too much. It's too volatile, so it's not predictable, right? So that's the next thing. Then we look at the annualized returns and annualized volatility. That is simple. Yeah, you simply just multiply it, or you put it to the you raise it to a number of the amount of days that you have in a trading year. Really, that just tells you, like, these two numbers are there to calculate a Sharpe ratio, and a Sharpe ratio tells you how profitable your strategy is. And this is something, by the way, it's not just for bots. When you trade your account and you export your order history and you send it to me, I will give you a full analysis with the Sharpe ratio of your account as well. So you don't need a full trading bot or full trading setup if you want to know the Sharpe ratio. But the Sharpe ratio is good if it's positive. Above 1 is good. Above 2 is very good. Above 3 is excellent and very, very hard to achieve. This is a 2.8, so it's pretty solid. So now we go into the actual strategies, and this is what I mean. So this is a very, very consistent line, right? Here, on the other hand, this is Ether. It's probably the most profitable strategy that we have. However, it's getting more volatile, right? And right here, for example, it had a pretty big drawdown, for like half of 2023 before it recovered and went much, much higher. Same with Bitcoin, the Bitcoin strategy, whereas this strategy was going had a pretty big drawdown. This strategy had a pretty big drawdown, and the interesting part is that right here, that drawdown is not that big on the overall equity, right? Why is that? Well, because during the time when these two strategies had a drawdown, we had other strategies, for example, Solana, that went completely crazy, right? And did very, very well. So this strategy did very well, while these two strategies had a large drawdown, like one of the bigger drawdowns that they had in history, right? But there was Solana that was just carrying the whole system, right? And that's why at the end of the day we do not have a very, very large drawdown, and it's also very easy or relatively simple to recover from it, because we have multiple strategies that are trading at the same time and they're negatively correlated. So if this is also just the understanding of the markets, because the reason why Bitcoin and Ethereum, why these two had a drawdown here, was because we were getting into a low volatility period, and as money was flowing out of the main coins, Bitcoin and ETH, the first coin that was taking off were altcoins and was Solana. So while Bitcoin and ETH were going down, Solana was going up, and that's where you have your negative correlation. And that played out really well in this situation. And if we would go into detail during the drawdowns on other places, we would have something very similar coming up. That's why they were bundled together this way. So Doge had a really, really nice run here. That's also really just a hedge against main coins, to make sure that you can never say that, like, a lot of people have this, some altcoin just takes off, Solana just takes off, goes 2x, 3x, and everyone has FOMO that they weren't in Solana, and then they will do something stupid, right? Well, we think about that too when we design the index. This is a QC index, by the way, and we put in basically schmuck insurance, right? So we put in altcoins. So in case altcoins just take off, the strategy, what it does is basically just catches the trend. So whenever we have a huge trend, those strategies will catch that trend. So we can still trade our consistency strategies and not have huge, and not catch huge moves, but have our consistency there, and we will still catch the big moves because our other strategies are designed to do that. So that's why we have that. Then we have FTM, very similar situation here. These spikes are really just whenever it's taking off. Solana also very well. Solana has been doing well in general as a coin. So we're just catching those moves. And this is then compared, this is something that investors look at, comparing the strategies to the to ETH or to the actual coin, and see, did the strategy outperform the coin? Because what very often happens is that there's strategies, and it's this crazy strategy, whatever you call it, AI and whatever. But then you look at its performance, and then you look at the performance of Bitcoin, and Bitcoin outperforms the strategy. So there's no point for the strategy really, because you could have just held Bitcoin and would have been doing better without the additional risk of the strategy. So something important that we're looking at, and we're looking at the overall performance of the coins together with compared to the strategy. So that's what it is right here. There's Bitcoin, its profit, standard deviation, volatility, and so on and so forth. Same with Doge, same with FTM, and same with Solana. And then we just have the overall account size growth. And then these flat wallets are basically, they're empty, so not very relevant right now. But what this is that if we go into high leverage situations, based on how much risk we tolerate, every single time there's a profit, we basically have a tax that we take off of those strategies in order to secure profits, and we put that into our what we call a profit wallet. And that profit wallet then can only trade very low risk trades. So really we just we either buy ETH or we buy Bitcoin with it. So the money that has been generated already and has been put there as a security because those strategies are very volatile when they're at high leverage, then it can still make money, right? It doesn't just sit there, but it's just, we just hold Bitcoin in a bull run, and that's it, So that's basically what we do. So yeah, that's basically it. When we look at the 2x, it's pretty much the same thing. The results are larger, but we have more volatility. The max running drawdown here is 85%. So it's very large, and it was right here. And that's a very large drawdown. And many people and most investors really would not be able to sustain this or be okay with it in the first place. But then some could as well if they're too aggressive with it. So, but the result is like 5x of the 1x account. If you ask how is that possible if it's only a 2x leverage, it's because we're compounding. So when you have a 2x leverage compared to a 1x leverage, on a 2x leverage you make double the profit, but then in your next trade you can trade with double the profit, right? So you compound much more, and that's the result of it. However, the drawdowns, because you're trading with more money every single time, the drawdowns are going to be larger, so it's more volatile. So that's what you see here. And the drawdowns are not double, they're more than double because you're compounding, right? So that's it. And you can see, like, putting it next to each other, you have more profits here. Yes, this is without a profit wallet. But you can also see the drawdown here compared to the drawdown here is much, much larger. And when we look at Ethereum, same thing, the drawdown is much larger. Same with Bitcoin, the Bitcoin drawdown is very large here, right? But then again, if we look at Solana, then the profit is much larger too, because this one made 400 grand, or like 390 grand by itself instead of 160. So so the profits are larger too, obviously, when you 2x, and that's basically it. The rest is the same. So that is the important part. When you use leverage, really need to understand what leverage is, because when you actually play out leverage over a long period of time, this is how it looks like. And yes, you can have more profits, but it might not be worth the drawdown compared to it. If we look at the Sharpe ratio, is actually still pretty good, but you can see that it's lower. Even though we made more profit, much more, we made 5 times as much profit, but the Sharpe ratio is lower than the original. Why? Because the drawdown and the risk and the volatility is much worse. It's much higher. So the Sharpe ratio actually, so if an investor looks at it, then this way, even though this one made $5 million, is a worse setup than this one that only made a 900 grand, because this is just a percentage, right? If an investor has $100 million to invest, it does not really matter for them, because like they will cap out anyways, right? They can't really invest $100 million in the way we have it right now with the altcoins, because the slippage and the market impact would be too high. So they cap out anyways. So they might as well do the no leverage one. And like if they're like this, if the 2x made 5 times as much profit, but has a much larger risk, well, they would rather just put in 5 times more money in the low risk one, right? And the result is the same, right? But the risk is much, much lower. So if your investment or if your money is not an issue, then you use leverage this way, by just adding in more money rather than leveraging your money and risking more. So that's basically it. All right, so that's essentially all I wanted to cover today. There's to recap, we're in a volatile market. In order to trade it, you need to do it in a way where you have a strategy, or you have a theory behind it and a strategy that you stick to no matter what. There's 3 strategies that I'll be trading, which is number 1, trading the market as it is with the stock strategy. So usually only looking at longs, meaning that whenever the stochastics are showing us longs on a larger time frame, on Total 3, on Bitcoin, on any altcoins, that's a good entry for longs, number 1. Number 2, we will be looking at different buckets of altcoins RNDR, STX, XRP, Solana, those are likely to do pretty well. So just have a portion of the funds there, basically not touch them. See you in 2025. And the last thing is our auto trading, obviously, which is the most profitable one because we are eliminating the human factor, and we're also eliminating the fact of a strategy not doing well because we have multiple strategies that help each other out and are negatively correlated. So the overall account is pretty consistent in going always higher. Pretty consistent, right? Not always consistent. Like there's max drawdown is 30%, which is not nothing, and that drawdown, took a couple months to play out. So also, like, that's not fun to be around, but we know that the strategy, the core of them, works, and it has been proven to work over and over and over again, many times over on the live account. And these are real numbers, including fees and slippage and market impact and everything. So yeah, that's basically it. And I think I covered everything I wanted to. If you guys have any questions, let me know. I'll be around in the Discord. We'll have another live call tomorrow talking about specific coins, altcoins, and things to invest in. And yeah, other than that, if you have any questions, let me know. And I'll see you guys in the Discord.